Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. Thank you so much for joining. We're excited today to discuss Trump opens up 401k plans to private investments, what this means for your solo 401k. If you have questions or topics that you want to discuss, whether on this topic or on any other topics, please chat those over as we'll go through the questions and topics. I see we've got a few already that have been chatted up. We'll knock out those early ones, and then we'll dive into the content. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Again, we're going to turn to the topic here shortly, which is Trump opens up 401ks to private investments, what it means for your self-directed solo 401k. But we'll first take care of some of these early questions. Must you designate an after-tax contribution for 2024 if made today? Similar to what you needed to do with an IRA contribution if made after December 31st and you want it to count for 2024. So you don't need to designate it per se. Of course, it would be prudent to do that in the records, just as a good record-keeping matter. What's really most important, though, is that you're just tracking it as a 2024 contribution, that you put it into a separate voluntary after-tax account. Now, after-tax contributions don't need to be reported on the personal or the business tax return. So really, it's just a matter of making sure you've got the self-employment income to justify that contribution, making sure you're keeping track of it. It could just be on a separate spreadsheet so that you have a record of what it was. When you deposit that contribution, if there's any type of memo or similar field, it would be prudent to state that this is a 2024 voluntary after-tax contribution. But all that's really just a nice to do. It's not an essential. What's really most essential is that the contribution, it was in the contribution limits. You have the income to justify that contribution. It's made to a separate voluntary after-tax account, and it's contributed by the deadline, which is going to be the business tax return deadline, including any timely filed extension. Then the second step is going to be to move the money from the voluntary after-tax account over to either a Roth solo 401k, so in the same plan, or you could move the voluntary after-tax funds out of the solo 401k to a Roth IRA. While the first step of making the contribution, that didn't need to be reported on the personal tax return or the business tax return. The second step, when you move the money from the after-tax account either to a Roth solo 401k or to a Roth IRA, that does need to be reported on a Form 1099-R for the year of the transfer. So obviously, if it's happening here in 2025, it's going to be reported on a 2025 1099-R. Now, we handle that 1099-R as an optional free service for our customers. Customers just have to let us know by submitting the online form on our website to give us the information we need to prepare the 1099-R. So you could just submit that online form shortly after the transfer from the after-tax account, either to a Roth solo 401k, there's one form for that category, or if it's going to a Roth IRA, there's a different form on the website. You can easily access the forms at mysolo401k.net/forms. Great question. Thank you for bringing it. I want to verify which category my Roth and solo credit union accounts are so I can take the RMD. So you would verify that by just based off of the account type that was set up when the account was set up. So if you have a Roth IRA, that's not provided by us. We're providing the 401k plan. So that would be provided by, for example, the credit union. So you would just verify with them, okay, which one of these accounts is my IRA or my Roth IRA? And then the bank account would have been set up under the name and EIN number of the plan. Now, we obtained the EIN number when when the customer is being onboarded. So that would be how you would determine whether that account was for the solo 401ks if it was opened up under the EIN number of the plan. All right. So thanks for bringing the good questions. So the executive order. So now we're back to our topic. Again, Trump opens up 401k plans to private investments. What does this mean for your solo 401k? And I see more questions are coming in. That's awesome. Please continue to chat those over. So let's lay the foundation. So news reports are coming out that Trump is planning on issuing an executive order. The president is planning on issuing an executive order to direct Department of Labor and the SEC to expand private investment access. So these would be the relevant bodies, the regulatory bodies that govern not only investments, but 401k plans. And of course, there's a huge pool of funds in 401k plans. I mean, we're not just talking about solo 401k plans. We're also talking about full-time employer plans, right? So big corporate 401k plans. And the idea would be to expand the investment options that are available to those participants in 401k plans generally, to include PE, so private equity, venture capital, real estate, hedge funds. Now, for the self-employed, with no employees working for any business owned by that person or a spouse, if any, who are therefore eligible to set up a solo 401k, if they set up a solo 401k with a company like us, like my solo 401k Financial, the great news is you've already had the ability to invest in private investments. Our plans already allow for these types of investments. So Trump is not changing the rules that apply to 401k plans at the statutory level, because the statutes are changed by Congress, of course, and the statutes already allow for those wide range of investments, provided that the plan documents allow it. The challenge is that big corporate 401k plan documents don't allow for those types of investments. And oftentimes it's because they are concerned about being sued, right? That they may offer investments under those plans that the participants may lose their money, and then ultimately there may be the sponsor, right? The employer may be hit with a class action suit, so they keep it vanilla inside those 401k plans. But with a solo 401k plan, if the documents allow for private investments, which, for example, our documents do, then the self-employed individual can invest in those types of investments. And obviously, you don't have the same litigation risk because it's just the solo 401k owner investing their own money. You control the investments, in other words, as the trustee of your solo 401k plan. So while this is getting a lot of news coverage, and there's, of course, commentators on both sides, for our customers, for our community, for solo 401k, self-directed solo 401k holders, like in our community, they've already had this ability to invest in private investments. So it's great in the sense that it's just shining a light on this feature. If you may not be aware that these are types of investments that can be made, of course, according to the rules, if you have a solo 401k plan through my solo 401k Financial. Now, it's all, again, there's commentators on both sides. Of course, some are celebrating the news, whereas others are more cautious as far as the risks of these types of investments. So let's talk about the rules and the risks. So with any type of solo 401k investment, it needs to be made under the name and EIN number of the plan. In other words, an individual cannot use their solo 401k funds to make an investment in that person's own name, right? That would be a prohibited transaction because it would personally benefit that individual. It also would cause all types of probably compliance headaches, because to the extent there's any income that's reported to the IRS with respect to that investment, if the investment is made under the name and social security number of the solo 401k owner themselves, the IRS is going to now understand that income that's being reported is income that's flowing to the solo 401k owner. So they're going to look for that income to be reported on the tax return of the solo 401k owner. So that's why the rules are there. I mean, number one, because of the prohibited transaction rule, you can't invest your solo 401k funds to personally benefit yourself. So the investment needs to be made under the name of the solo 401k and the EIN number, which again, we obtain that EIN number as part of the onboarding process. And then just as a practical benefit. To the extent that there's ever any income reported with respect to that investment, it's going to be reported under the name and EIN number of the plan. So now the IRS understands that that income is growing on a tax-deferred basis, potentially tax-free if it's an investment that's held via a Roth solo 401k. But the IRS is not going to be looking for that income to be reported on the personal income tax return of the solo 401k owner personally, because again, it's being reported under the EIN number of the plan. Now, additional rules and mechanics would be when the investment is made, the solo 401k owner signs the investment documents. For example, there might be a subscription agreement for a certain private investment. So the solo 401k owner would sign as the trustee, not personally. It needs to be a passive investment, so no personal benefit. So there can be no finder fees, for example, paid to the solo 401k owner. They can't invest in an investment where they're on both sides of the table, right? Like let's assume that it's some type of investment in a business, right? Well, the solo 401k owner can't be working in that business or can't be a contractor to that business, right? Because that could be construed as a personal benefit. It's got to be a totally passive investment. Now, in terms of fees, based on experience and client feedback, typically these private investments have higher fees, right? Especially compared to, for example, a index fund, which may have relatively very low fees. Additional risks would be just the fact that private investments are less liquid, harder to value, right? Because a lot of times there's less information, right? Compared to, for example, publicly traded stock, where that can be bought and sold almost immediately on the stock exchange. And there's a wealth of information because there's information reporting requirements by the publicly traded companies, as opposed to investing, for example, in a private company. It's like a pre-IPO company versus a publicly traded company. Now, why consider private assets? Well, according to those that are celebrating this news, right, it's that there's a potential for higher returns versus the public markets. It's just another channel for diversification, right? So that the argument being that with a new pool of investments, now the 401k participants could put some money maybe in private investments, others in maybe a money market, maybe additional investments in a exchange traded fund, right, that tracks the stock market, to give the participant diversification with respect to their investments to ultimately protect the participant, right? So that if one pool of investments goes down, perhaps the other stays the same or even goes up to offset that risk, right? And then if you also were to look at, for example, real assets like real estate, that can be a hedge against inflation, access to pre-IPO deals. So these are the arguments that folks make in terms of why this is a good development. Now, for those with solo 401ks, you may have a basic plan. For example, a solo 401k at a discount brokerage like Fidelity or Schwab, which of course is not going to allow for investing in private investments or other alternative investments. So if you're in that category and you want to take advantage of those types of investments, you would need to upgrade your plan to a plan like the solo 401k plan provided by my solo 401k Financial that is going to allow for these types of investments. Other practical considerations would be just consider limiting to the percentage of assets. In other words, many would say not to put all your 401k assets into one investment or even one category of investments, to the diversification point we were discussing above. Just consider the fees, liquidity, manage your track record. In other words, just doing your due diligence with respect to the investment and really understanding the costs and liquidity of that investments. Many would say that this may be preferred for younger investors just because they'll have longer horizons, right? Just the time that it takes to realize the upside to a private investment may be longer. And again, with the liquidity consideration. And obviously all of this is being provided, as we mentioned, for educational purposes only. And you'll want to discuss it with your personal tax, legal, and investment advisors, but this could give you a good framework for that discussion. So again, the key takeaways here are self-directed solo 401k plans like the one offered by my solo 401k Financial, already support private deals, know the rules, right? So if one makes these types of investments, it's got to be important to follow the rules in terms of making the investment under the name and EIN number of the plan, ensuring that it's a passive investment that doesn't benefit the solo 401k owner personally. So ultimately, it's an opportunity, but with any opportunity comes with that responsibility and just to educate before investing. All right, so now let's turn to the additional questions that got chatted over. Thank you for bringing the great questions. We appreciate that. So his solo 401k is maxed at $69,000 per year, which for 2025, the limit's gone up to $70,000 or even more if you're age 50 or older. Now, is that per employee or per employer? So it's going to be at the employee level. So if you have two participants in the solo 401k, right, like a husband and wife that are both working in the same business, each person is able to contribute up to $70,000 for 2025, assuming they have the self-employment income to justify it, et cetera, et cetera. So it's not across the whole plan, it's at the participant level. Now, if it's one person, but they are participating in multiple 401k plans, or maybe they have a day job, first of all, they can only use the self-employment income to justify contributions to the solo 401k. One can't use W-2 wages from a day job to justify contributions to their solo 401k. Now, the employee limit, which, for example, is $23,500 for 2025, that applies across all the plans that the employee makes contributions to. So if somebody maxes out contributions to their day job plan, they're not going to be able to make any more employee contributions to the solo 401k. But the employer contribution limit and the voluntary after-tax contribution limit is at the plan level. So even though that person may have maxed out contributions to their day job plan, they could still max out employer and or voluntary after-tax contributions to the solo 401k, provided that they have the self-employment income to justify those contributions. Now, the one exception to that rule, that the employer and voluntary after-tax contribution limits are not reduced by contributions made to a day job 401k plan, would be a 403b plan. So if contributions are made to a 403b, right, say through a day job employer, and the person is also separately self-employed and therefore eligible to make solo 401k contributions, you've got to consider the 403b exception to that general rule. So under the 403b exception, all contributions made to the 403b, whether by the employee or by the employer, together with any contributions that they want to make to the solo 401k, the sum of those contributions cannot exceed the overall limit. Great question. Thank you for bringing it. If you have a solo 401k for your S Corp and want that solo 401k to invest in another business you own, is that allowed under this new Trump law? No, it is not. It is definitely not. Great question. You still cannot personally benefit or invest in a disqualified person, which would include an entity owned by the solo 401k participant. Good question. Thank you for bringing it. Can money earned from my regular W-2 job be placed into the after-tax portion of my solo 401k? No, you need self-employment income to justify contributions to the solo 401k. And you can't save more than you earn, right? So your ability to contribute to that solo 401k is going to be based on the self-employment income. Now, that could be W-2 wages, but it would be W-2 wages from, say, your business taxes S Corp or C Corp. W-2 wages from your day job cannot be used to justify contributions to the solo 401k. Exactly. That's right. Thank you so much for the great feedback. And thank you for the great participation. We invite you to our community, mysolo401k.net/my community. We've got over 30,000 members. It's totally free to join. If you email us at business@mysolo401k.net, we'll get you on the community. So we also invite you to subscribe, whether you're watching us on LinkedIn or X or Instagram, as we go live every day. So you can bring questions. You can just see the topics that we want to share. And also, if you like the video, that'd be super helpful, as that'll help us get the word out to others other self-employed individuals, other solopreneurs. There's a growing number of solopreneurs out there. So this information could be super helpful to them as they try to maybe catch up on their retirement or just otherwise secure their retirement savings. But it looks like that takes us to the end of the questions for the debt for today. We appreciate the opportunity. Again, please like, please subscribe, please share with others. And until next time, thank you so much.